All right, my friends, we are live. Scott, Mike, Ryan, Kevin, really appreciate you guys, man. Let's rock and roll here. Let's have some fun. We'll kind of wait a minute or two to give people a chance to kind of file in here, but really excited about moderating and hosting this debate. You know, when I did the last one, single family versus multifamily, I had in the back of my mind, if I do this again, I definitely want to do storage and mobile home parks, and I knew exactly who I wanted to have on here. So really appreciate you guys. I already see we got up to 9, 10 people live, and I'm sure that number will grow. So, my friends, I want to welcome you to the Flip Empire Show. Welcome you to this second debate we're doing, real estate investing heavyweights. I want to kind of just take a quick minute or two and share with you why, like, what's the reason I'm doing this debate and what's the reason these gentlemen have agreed to give their valuable time. First and foremost, it's to give back to a charity called Graces, which essentially is a nonprofit that helps impoverished families in Antigua, Guatemala. These are families that prior to the pandemic were living under $300 a month. That's what they were living, a family of four, family of five. Post pandemic, they're living under $200 a month. They're obviously not getting any help from the government. Many of these families don't have education. They don't have kids at 10, 11, 12 years old. They're hitting the streets, selling trinkets and things of that nature just to help their families put food on the table. So the reason we're doing this is in an effort to raise some money for this charity and ultimately have this money go directly to the Grace's Meals on Wheels, which provides food and helps with their education. So secondly, we want to educate you guys. We want to inspire, and I can guarantee you that you will be entertained. I got some incredible people, just go-givers, huge hearts. And if you guys would have been backstage, you would have heard some of the smack talking already kind of going on. So we're gonna have a lot of fun, my friends. I'm actually gonna throw up the URL. I want to kind of get this out of the way. So if you guys want to head over to reidebate.com, reidebate.com. This is the way it's going to work. Scott Myers, Mike Wagner, Kevin Bupp, Ryan Norris, each of them have agreed to give away a valuable resource. In Scott's case, it was a self-storage investing course. With Mike, it's a valuable PDF that I've been through that's packed with content. Ryan is giving away his due diligence checklist on mobile home parks. And then Kevin is giving away his valuable time, and you can hop on the phone and do a strategy session with him. This is 100% the honor system. Go to reidebate.com, opt in there. You're going to have an opportunity to make any donation. Guys, it could be $1, it could be $10, $1,000, whatever's in your heart to give. If you find it in your heart to give, just go ahead and make a donation, and then you can go ahead and access those resources. So just wanted to put that out there, a little bit of housekeeping. And then what I'd like to do is now share with you the format of this debate. And then I'm going to kick it over to these gentlemen to introduce themselves for 1 or 2 minutes. And we're going to get rocking and rolling with the debate. One thing I do want to mention, we want to make this interactive. We want to have some fun. If you have some questions, if you have comments, if you want to comment on who you think is going to win the debate. And I say win in air quotes because nobody's walking out of here a loser. We're all winners. Mike Wagner joked that, you know, the Vegas odds were that Graces and the people in Guatemala, those are the true winners here. Those are the people that, if you guys find it in your heart to donate, are going to ultimately end up on top. But if you guys want to ask any questions, we're actually going to open things up at the end of the debate, 15 to 30 minutes. And we're going to do live Q&A. Again, we have about 2 hours blocked off here, 90 minutes of debate, and then 15 to 30 minutes of Q&A. So I already see some comments and some questions coming in here. Justin Morgan, let the fun begin. Steve Kavanaugh, debate. Mobile home park win. Nah. So guys are already having some fun here. If you guys want to comment on who you think is going to win the debate or any questions, go ahead and fire away. Guys, here's the breakdown of the debate. We're going to go 5 rounds. We're going to cover round 1, acquisitions, round 2, dispositions, round 3, financing, round 4, construction, and then round 5, management/operations. Each asset class is going to have 5 minutes to debate as to why their asset class is superior or superior to the other in each one of those categories. So we're going to go round by round. Each side will have 5 minutes, and then we'll kick it over and we'll do 2.5 minutes of rebuttal. Okay. Then we're going to do a bonus round, which I'll reveal at the end what the bonus round is going to be. So now that we have the format and all the housekeeping taken care of, I want to kick it over to Mr. Scott Myers. Scott, if you could just take a minute or two, man, introduce yourself. Who is Scott Myers? And we'll go from there.
Happy to. And once again, thanks, Alex, and welcome everyone. We're going to have a lot of fun here. So got involved in real estate back in 1993, came up through the Ron LeGrand system, if you will, buying houses. We were on the path of buying single family rental houses, rehabbing them, refinancing, renting them out, and then selling on a lease option until we got up to about 70 houses, and realized that unlike Ron and the other gurus said, we didn't have a whole lot of time on our hands or a lot of free cash flow. So I thought, well, economies of scale will fix this, and got into apartments and started buying apartments around central Indiana. And we got up to 420 some apartment units as well. And same thing, just found out that we really didn't have the cash and the freedom like we wanted. So I thought, well, for all the reasons we all love real estate, appreciation, depreciation, you can borrow money, leverage to buy it. And when you put a renter in, they pay down your basis and you get the tax benefits of that as well. There's no other investment out there like that. If it weren't for tenants and toilets and trash, it'd be the best business model, period. And so then I began looking around at other asset classes in real estate, and outside of self-storage or parking lots, that was really it. Everything else had tenants and toilets and trash. I began looking at mobile home parks, but tenants and trash on wheels. And so I decided that self-storage was the way to go, and then began researching, learning about the industry, bought my first self-storage facility in a partnership and saw the light. And after that, sold all our houses, sold all our apartments. There's only one house I own now. It's the one that I live in. And everything else that we've done for the past 15 years has been nothing but 100% in self-storage. So we syndicate. We put deals together with private equity partners. We develop self-storage facilities all around the country. We buy existing facilities and turn them around, as well as conversions. So we buy big box warehouses or empty industrial buildings and convert them to self-storage. So really everything from A to Z, soup to nuts.
Awesome, Scott. Thank you, sir. And your partner on the storage side, none other than Mr. Mike Wagner, the storage rebel himself. So Mike, just a minute or two, man, a little bit about who you are and your storage business.
Yeah, very quickly. First and foremost, I am a husband and father to those beautiful kids back there. Everything we do in the storage world is meant to support a lifestyle, our own vision of success, and it's done a very efficient job at creating that lifestyle for us. So, long story short, I was a physical therapist by trade. Knew I wanted to get into real estate for many of the reasons that Scott just mentioned above, and started, like many do, doing what's now called the BRRRR method, just buying small single family and multifamily houses. And after several years, it was going okay. I was making money, but I realized I wasn't getting where I wanted to go fast enough. And that was out of a rat race into a life of true success and fulfillment. So I kind of pivoted. And ironically enough, I looked at both mobile home parks and storage. This was back in 2010, 2011. Looked at both of them as a better opportunity than what I had been trying, and ultimately decided on storage for a lot of reasons that we're going to talk about as this debate goes on. Since then, I do a very low volume, high margin investing strategy. I've only done 5 deals, not a million like some of these other guys. Neither's right nor wrong, but we do low volume, high margin deals because I saw that as the way to get to the life I was after as quickly and as efficiently as possible. Over the last 2.5 years, started teaching other people how to do the same thing.
Awesome, Mike. Thank you, sir. Mr. Kevin Butt, man, what's going on, dude?
All righty. No, I'm doing awesome, Alex. Thanks for putting this together, and for all you do, my friend. And I tried to find some boxing gloves on Amazon, but dude, this supply chain disruption, they're not available. Everyone bought all the fitness equipment, so I was going to come readily prepared. But anyway, no gloves today. But excited to be here with everyone. As far as like my background, I've been a full-time real estate investor, I guess you could say, my entire adult life. I never really had a real job. I attended bar for a period of time going through college, and then ultimately was luckily introduced to real estate at 19. I bought my first property when I was 20. Really focused on single family properties for the first 5 to 6 years of my investing career. Acquired quite a significant portfolio of over 100 single family homes, and then also started buying apartments thereafter, just shy of 500 apartment doors. And my first phase into real estate didn't really treat me all that well. It ran me up through 2008. 2008 was an incredibly challenging time with my portfolio. Found myself basically not fully bankrupt, but basically with negative cash in the bank account, and lots of my properties going back to the bank. And then took a couple-year hiatus, and then jumped back in 2010. really looking to reinvent myself. And I went on a journey of finding out what the new world looked like, right? 2010 was very different than 2007. And during that period, I stumbled upon mobile home parks. I bought, a home study course online and literally started diving into it, and ultimately realized that it was very much an untapped industry. Now, this is back in 2010. Times are very different today, but it was very much an untapped industry, and it was one that seemed to be incredibly lucrative if you purchase right. And so bought my very first mobile home park in 2011 up in Atlanta, Georgia. We still own that asset today, and bought another one shortly thereafter, a third one, a fourth one, a fifth one. Today we have 19 mobile home parks. We've owned I think 28 in total, all throughout the United States, and we absolutely love the business. It is by far, hands down, the best type of real estate I have ever owned. And in full transparency, I will say that I also do love self-storage. I have some investments in self-storage, and they pass away, but even then, mobile home parks absolutely kick their butt. So with that being said,
Kevin, you might be teeing it up for these gentlemen, man. Be careful.
No, it's okay. I'm very diversified, but my core focus is mobile home parks. We do it day in and day out. We're in the trenches, and we also teach it through my podcast. I've got 2 podcasts behind me. You can see the Real Estate Investing for Cash Flow podcast and also the Mobile Home Park Investing podcast. So we live, eat, sleep, breathe mobile home parks day in, day out.
Yep. Awesome. And each one of these gentlemen, before we kick it over to Ryan Norris, each one of these gentlemen have an awesome community. Scott has a podcast, self-storage podcast. Mike Wagner has the Storage Rebellion. And so at the end of the show, we will go ahead and put everybody's link here where you can connect with them. Definitely encourage you follow each and every one of these gentlemen, particularly if you're interested in one asset class or the other, but all great guys. And I encourage you to plug into the materials and the education, the content that they put out. So Mr. Ryan Norris, now I want to be fully transparent. Ryan and I don't even know each other that well. We have connected on a few phone calls. I reached over to Kevin and I said, Kevin, when it comes to mobile home park investing, give me 2 or 3 names. And Ryan was at the top of that name. So we hopped on a call, and come to find out, we actually have a lot in common. He used to live in South Florida. He knows exactly where I'm at here in Miami. And we just vibed. We connected. Great dude. He's got an awesome community as well of mobile home park investors on Facebook. And so let me tee you up with that, Ryan.
Yeah, Alex, first and foremost, thank you. And Kevin, thank you for inviting me. And look, before we get started, I personally believe if you are going to debate or roast anyone, you have to first be comfortable debating or roasting yourself. So I'm going to start this party off by making fun of myself. Look, before we hit the record go live button, these gentlemen on here made fun of me for looking a little bit too comfortable, like I was going to take a nap before this. And I'll say, look, it's really quite simple. I can win this debate. Kevin and I can win this debate in our sleep. So I came dressed for the occasion. But a little bit about me. First and foremost, I'm a big giver to charity. That is a big part of my why. So, Alex, I am so happy to be here and hopefully help a wonderful cause. But just quickly about me. I'm a 33-year-old millennial who bought the lie. And what's the lie? The lie is study hard in high school, then you get into a good college, and then you work really hard at the good college, and you get a great job, and then you work really hard at this great job, and you get promoted, and you retire on a beach one day. Well, that may have been true for my parents and my grandparents, but at least for millennials like myself, that wound up in student loan debt and soul-crushing corporate America jobs that gave us literally no out. I mean, it was depressing. I felt stuck. I didn't want to get promoted. I couldn't leave because golden handcuffs and student loan debt. And I wanted out. And so I just refused to listen to folks who were telling me things that ultimately weren't really getting to me to my dream, my goal. And after years of introspection and trying to find a business to start, I finally found, like Jim Collins had said, the intersection of the pivotal 3, what you are passionate about, what you can be the best in the world at, and what is also lucrative. And thankfully, within mobile home parks, after spending years of looking for businesses to start, I found that intersection between all 3. Flash forward 5.5 years later, we started in July of 2015. And actually, Kevin Bupp was one of the pivotal first people to really help us get started. My business partner, Ian, and I have now been a part of 17 mobile home park transactions as of this afternoon. Actually, after this, I'm going to go and notarize, sign, and submit my closing documents for our 17th acquisition. We did sell out of 3. So we actually have 14 that we own, 13 of which are under our management, and 1 we own passively. And all of this starting with nothing, no money, no experience, and no network. In fact, arguably negative, because I got saddled with student loan debt. So anybody listening in here, I really hope that you enjoy this, you learn from this. But if you get nothing else from me personally out of this, get this: you do not have to be doomed to the lie that they told us going through high school. You don't have to be. Don't settle for excuses. You can fight through them. And I hope that my words can inspire you to not only do good and give back to charity, but to, like the other gentlemen on this board today, you too can chase your dreams and achieve your goals within real estate, whatever asset class you pick.
Yeah, well said, Ryan. Thank you for sharing that, brother. I think everybody echoes those sentiments. So, guys, now that we have that out of the way, let's dive into the juicy part. Let's dive into the debate. Let's have some fun. Now, for those of you watching at home or on your phone, wherever you are, you're going to notice me throwing up these cue cards. Like I said, each round, each asset class is going to have 5 minutes. You'll see me throw this up at the halfway mark. Admittedly, it's a little bit of a challenge to, like, sometimes keep a track of time, stay focused, all that kind of stuff. So bear with me. And then I have a 2.5 minute, a 1 minute, a 30-second. And then if you see me throw this up, I want you to give these guys some crap and throw some comments up there, okay? So this is going to be their cue to wrap things up if they're talking. So after that, each side will have a 2.5 rebuttal, and then we'll go round by round, and then we'll do a Q&A at the end. So again, one last plug, REIdebate.com. Go ahead and opt in there, and there's going to be a video there. Don't watch that video now. Watch it after the debate. But then that way, I want you guys to have that site bookmarked so that whenever you have an opportunity, I want to encourage it to be today, ASAP. Make a donation if you find it in your heart. So without further ado, guys, let's hop into the second real estate investing heavyweights debate. We're going to actually start with the storage side on this. So whoever wants to kick this one off, whether it's Scott or Mike, here's the question. When it comes to acquisitions, why is storage the superior asset class?
Yeah, Alex, I'm going to start off with this one before I turn it over to Scott. And, I know you well enough, Alex, to know that you've got a broad range of listeners. And I want to try very quickly, if I can, to speak to all of them. Starting with the folks who maybe are early on in their journey, the ones that Ryan was maybe just speaking toward. For them, what I think I like about both of these assets is the low barrier to entry, right? To Ryan's point, you can get into either asset class for $100,000 or $200,000 property. How much you have to put into that? Maybe nothing, maybe a small down payment, doesn't much matter. I think both asset classes offer that. But where storage takes a distinct advantage is that we hit in the storage industry economies of scale for profitability far sooner than mobile home park operators do. We've got things that are so in our favor when you compare the two industries that we can make good money on very small properties without having to pick up the broom or the plunger or do the credit checks ourselves. We've got automation, remote management. Our income to expense ratio is lower, so there's a higher margin for error, and we'll touch more on that later. But like I said, we don't have to show units or do credit checks. We don't have to deal with owning property like park-owned homes that so many mobile home park operators will tell you are the bane of their existence. So for the newer investor, this is storage is a clear front runner when it comes to getting started, just because you can get to those economies of scale sooner. Now, if we flip the coin a little bit and talk more towards some folks that maybe have more experience, maybe they're playing at a little quote unquote higher level, I think it's really important to look at the state of the industry as a whole. How has it been trending for the last 10 years? And based on that, where do we see it going in the future? And again, similarity between both asset classes is this idea of consolidation, meaning the biggest players in the industry, the REITs, the big guys, the Kevin Bupps and the Scott Myers of the world, they are taking more of the market share as time goes by. And I think we can all agree that that's kind of both a blessing and a curse. As the consolidation happens, cap rates can compress and the value of our properties can go up, which is clearly a good thing. And again, it's true in both industries or both asset class. But I think the more important consideration is if we look at the curse embedded in this consolidation and if you think about it, as the big guys are expanding into the market, it becomes harder for smaller operators and investors. And when I say smaller, I mean anyone other than the big REITs. It becomes harder for them to get in the game. Now, here's the key difference, right? If you look, as the consolidation occurs, storage is still a flourishing industry. There's still construction that we'll talk about later. There's new development. Simply put, mobile home parks aren't being built anymore because the municipalities don't want them, right? So I hate to say this, but if you're getting into mobile home parks today, you're signing up for buying into an industry that is essentially dying a long, slow death and no change in sight on the horizon. You're also signing up for a life of fighting City Hall. So if that's what you're looking for, then maybe mobile home parks is a thing. But I'm going to personally choose to stay in the realm of storage for those reasons. And now, Scott, I don't know if you had anything you wanted to add on that.
Yeah, well, there we go. Game on, right? So I'll just speak from experience in a little bit of time that we have left here, Alex. And that's for anybody looking to get in. I'll talk about the beginning side and then a little more advanced. And when I was looking to get into the business, like I said, I was at a crossroads where I was looking at other asset classes. And at the end of the day, the only thing that we don't have more of is time. And the time that is involved in just handling anything that does have tenants in it, regardless of the asset class. We spent so much time tracking down and chasing the tenants and then working with property managers and property management companies and then contractors for all the rehabs. These are, not to oversimplify it, but these absolutely beautiful buildings that you see there, self-storage buildings, they're metal boxes on concrete slabs with stuff in it. We just don't have all the moving parts. And when I sold my last single family rental house, and got rid of all of our tenants and toilets and trash, my wife, who's a business partner of mine as well, she said, "Hey, do you notice anything different?" This is the next thing I said, "What?" She goes, "It's quiet." It's quiet. And, so we achieved the E-Myth. If anybody's familiar with Michael Gerber and the E-Myth, systems run the business. We manage and tweak the system. The system was running us when we're in the tenant toilet business. But then when we have to focus on, when we can get to the place where we're focusing only on growing the business and doing the two things that are strong suits, and that is, finding private equity, raising more private equity, and then matching it up with deals. Well, we got a whole lot more time to be able to go out and create those relationships, our private equity partners and lenders, and then we can crank up our marketing machine or do more joint ventures and look at deals. But when we're so mired down with all of the issues of handling tenants and toilets and trash, that is what takes more of our time. And property management companies you can't wave a magic wand. They don't pay the bills and make all those decisions when all the bad things happen. So that's the reason why I decided to go this path versus the others.
Thank you, gentlemen. All right. So Ryan, Kevin, your turn. 5 minutes. Why is mobile home park the superior asset class when it comes to acquisition specifically? Whoever wants to kick it off.
Ryan, let me take the first stab at it if you don't mind, buddy.
Sure.
So I'm going to speak to Mike's point about mobile home parks dying a slow death. It is true that there are lots of regulatory municipal restrictions around building new mobile home parks. The not in my backyard syndrome. They've got a bad rap. Stereotypical rap about mobile home parks is that they're just they're junk. They're trailer parks. They've got drug, sex, and rock and roll, and that's just not the case. I think Ryan will agree with me there. But as far as how we look at that, I look at that barrier as a barrier to entry. It's a huge positive. What we don't have to worry about in mobile home parks is a competitor building 2, 3, 4 parks down the road and creating an oversaturation. Self-storage, on the other hand, they're popping up everywhere. I've got to be concerned about if I buy the self-storage facility today in Tampa, Florida, that the other big dogs aren't going to come in over the next couple of years and build additional facilities and then just crush my little dreams of making a lot of money in self-storage. So again, I look at the flip side of that, of new parks not being built as a massive benefit for us. We buy the right park in the right market. I don't have to worry about that competition. I've got built-in insulation from anyone coming and taking my dreams away from me. One of the other big things about mobile home parks where I think they just absolutely trump self-storage is, I think everyone that's listening, everyone's watching can agree, everyone needs a roof over their head. Everyone needs a roof over their head. Not everyone needs a place to store their junk, right? And when times get tough and there's a decision to be made about, making your budget for your family and which bill am I going to pay and which bill am I not going to pay, time and time again, an individual will choose to pay for that roof over their head versus storing that junk that they had, paying the $150 a month for storing that junk that they have. So I think mobile home parks, ultimately, they do really well in good times, and they do even better in bad times, because everyone always needs a roof over their head. And so, Ryan, go ahead. There's a couple more I'd like to go through, but I don't want to steal all your thunder as well, buddy.
So I love data. I have 2 wonderfully useless degrees in statistics right now. So let's pair Kevin's warm and fuzzy with some real data. So I would like to first and foremost say that over 95% of the tasks done at my stabilized properties are completely automated. The average mobile home resident within a mobile home park does not turn for 14 years, which is actually longer, according to the National Association of Realtors, for a stick-built home, which is about 13 years. So you have stickier tenants. Crime also is actually lower and is actually on par with a middle-class family. And again, if you don't own any of those homes, it's not a whole lot that you have to do. When you look at, for example, Williams Equity Research put out a study that basically found that the fluctuations of self-storage in terms of vacancy is higher than any other commercial real estate asset class by an order of 120 to 300 basis points year over year. Those are huge fluctuations for any data scientist like I was formerly, or anyone who's looking for good, stable income. So the truth of the matter is, when you're looking at where do I want a safe dollar at a really strong return, it's mobile home parks. When you look at, for example, some of the publicly traded REITs, for example, Sun Communities hasn't had a real significant decrease in NOI growth since the late 90s. The profitability is there. The automation is there. If you stabilize your properties, which some go for heavier value add stuff like me, because I'm getting into the space, the data just jumps off the page. And while I have only a couple minutes or a couple seconds here left, I want to say that beyond the data, it is a rare thing nowadays where you have the intersection between doing the right thing. It also happens to be legal, and it also happens to be profitable. And the amazing thing about owning and operating mobile home parks, no matter if you want to go all tenant-owned home or you do deeper value add stuff like I do, is you get to clean up communities. And if you look at macroeconomic data, especially when you look at education, so we have a partial college scholarship for our residents. When you look at the data, it pops off the page. Clean, crime-free, or relatively speaking, crime-free areas are better environments for kids to get their education and provide them an opportunity to lift themselves from poverty. Kevin and I get to do this every day. We're not providing a better environment for your old golf bags. No, we are pound for pound making communities, not within our communities, but within the greater cities, municipalities, counties, and states, better places to live. There is a disparity between the rich and the poor that is only getting greater, and the demand is insane. The supply is limited. Kevin and I are on the front lines of that. That is our why, and it is backed with data. So we have that intersection of the right thing to do, profitability, and everything. Hopefully right on time there.
Perfect timing, Ryan. So guys, just so you know, Scott did not lose. Scott is having to reboot. He's having a few tech issues. You might see me, glancing at my phone. It's because I'm checking the time, but he was actually texting me that he should be on any minute now. So Mr. Wagner, you did not lose your partner in crime, brother. But let's keep the show rolling. So here's where we have 2.5 minutes, and you might have the benefit of having the 2.5 minutes to yourself as Scott, attempts to hop back on here, but 2.5 minutes for the rebuttal. It could be any 1 point or multiple points that either Kevin and or Ryan, just talked about.
Yeah, and I would just want to make a couple points. I think that the first, going to what Kevin had said, I couldn't help thinking that what he was describing was mobile home parks are a great place to be. And because of the consolidation, if you're already in, then it's a great place to be. But I feel like we're talking to an audience who wants to know, where should I invest my money today? And for me, that's in an industry that is still going to exist and have expanded into the future. To your point, Kevin, about new supply coming on into markets for storage, completely viable point, but huge opportunities in areas where development simply doesn't make sense. So we can purchase value add properties, expand to meet demands in markets that are overlooked by anybody who's going to want to do a ground up development. Piggybacking on that, the whole economy thing, storage, this because you own storage myself. I'm pretty sure neither Scott or I own mobile home parks. So I'm just going to throw that out there. But secondly, this owning some storage, that we also do really well in either up or down markets. You had quoted this idea that when the economy's down, people don't need storage. But I can tell you, having experienced it, when the economy's up, Americans buy crap. We know that. They need a place to put it, so that drives our storage demand. When the economy's down, there are transitions through downsizing. Maybe people are moving from a house to a mobile home park. Well, there's no place to put anything in a mobile home park, so they're my customer too, every time, right? The other side to that is, I want to switch gears just a little bit and kind of to your points, Ryan, some very valid points. Some of them that I'm definitely going to rebut a little later in the later sections, but that's because you weren't talking about acquisitions, my man. You were talking about all sorts of operational stuff, basically avoiding the topic at hand because from an acquisition standpoint, storage is the better asset class. Neither of you addressed how acquisitions are a benefit to the mobile home investor who wants to start today.
Mr. Myers, you got about 23 seconds, man. Good to have you back. I know you had some tech issues, so I'm going to tack on an extra 10 seconds if it's okay with these guys.
All right, we're talking about dispositions, right? And why self-storage is better in terms of
this is the rebuttal to their acquisitions, which obviously you didn't get a chance to hear. But it's okay. We'll keep it moving. Let's kick it over to Kevin and Ryan for the rebuttal on anything Mike or Scott had to share with us.
Kev, let me start this. Let me hit him with some data. So first and foremost, we didn't directly address that because we wanted to demoralize you guys a little bit. But let's hit you with some more data here, right? So first off, Bloomberg just came out with a big article, and also Seeking Alpha did, that basically said that self-storage is actually 10 years ahead of mobile home parks in terms of consolidation. Let's put some numbers to that. 25% of self-storage is owned by institutional buyers. 18% of that is publicly traded, according to Mick & Law PC attorneys and counselors. Let's juxtapose that with the consolidation within the mobile home park space, which is that only 2.5% of the supply is owned by publicly traded REITs. And not to mention, again, the NOI growth is better by a factor of 1.5 to 3% of NOI growth this year alone in the middle of a pandemic. And also when you look at general collections trends during literally the worst pandemic since the Spanish flu, there was only one asset class that collected better than mobile home parks. And those were warehouses. And wouldn't you know, because we're all ordering stuff on Amazon because we can't leave our houses. Otherwise, people have been paying. They have been paying extraordinarily well. And you guys are just 10 years ahead of us in terms of consolidation. So acquisitions are pound for pound superior in mobile home parks. Kev?
Yeah, no, all great points there. And there's a few other tidbits that I thought we should hit on real quick while I have a couple seconds left. One of the big ones being, the tax benefits with mobile home parks. I mean, we missed on that part, and that is key on the acquisition side as far as what the depreciation schedule was. Self-storage, 39 years. Mobile home parks, the majority of the infrastructure, it's over a 15-year accelerated depreciation schedule. That, for those that know the power of depreciation, it's like a night and day difference. Mobile home parks just completely pound self-storage when it comes to tax benefits and tax efficiency. And Mike, back to your point about self-storage during a good time, during a downturn, what have you. When they have to make a tough decision of, again, what bill they pay, we can all agree that they're going to choose to pay for the roof over their head versus their storage unit that has whatever junk might be stored in there. And so, again, I feel when times get tough, folks are going to pay their rent versus paying their self-storage. And with that, I think we're out of time. So
yep. I appreciate that, guys. You guys are warming up here. So we're gonna head over and transition into dispositions. All right. So we're actually gonna start, and as you're gonna see, I'm gonna alternate back and forth so that it's fair across the board. I'm gonna give the mobile home park guys a chance to lead us off and kick us off when it comes to why do you guys feel mobile home parks are in a superior asset class. Specifically, now we're talking dispositions.
Yeah, go ahead, Ryan. Start us off, bud.
Sure thing. So when you look at how things traded, especially during this downturn, quarter two alone faced, or at least saw, $800 million pour into this space. Now, why is that relevant? Because realistically speaking, that sounds like a really, really small number. And it's true because there are only approximately 42,000 to 49,000 mobile home parks in existence. So it's a really niched asset class. So what's up with the big investment? Well, again, when you look at, for example, the turnover for something like, I don't know, self-storage, especially during a downturn when you have a lot of hands-on marketing and stuff to get people back in. When you have people that are staying put for 14 plus years and your rents average it from the 200s to and upwards of the 500s, and it's your house that you've invested in and it's yours. Wall Street has finally caught on to this idea because for the longest time, it's felt risky, even though the data just didn't back it up. And now that there is a significant yield gap, especially if you're looking at something like government loans that are pouring in, you can get sub 3% interest on some amazing Fannie and Freddie debt, which makes acquiring really nice communities a whole lot easier. And now you're playing the cap rate game, which completely changes the ball game for not just private equity shops, but people like Kevin and I who are raising private money to do our acquisitions. So in other words, it allows people who are starting with nothing to come in to sell. So Kevin and I both have sold out of properties. It's relatively easy to do now that the debt is matching there. And it's relatively easy for young kids with no experience, no network, and no money to get in, buy something, fix it, sell it, and then buy more on our own.
Yeah, and just speak to some of those points, Ryan. I mean, you mentioned the private equity side of this. Those folks that are coming into this space. You got the big names like Apollo Group, you got Blackstone, you got Carlyle. They're pouring billions into this space, and while most would deem that to be competition, I view it as an opportunity. It's an opportunity for those that want to get into a value-add asset, an asset that isn't fully stabilized, lends a lot of opportunity for the first-time buyers, the smaller type of investors to get in, fix something up, and then have a incredible exit if that's what they choose to do to one of these larger groups that are paying premiums for properties. In addition to that, the big PE firms aren't really much of a threat because it's very much equivalent to that of turning of a cruise ship, right? It doesn't happen quickly. It's not nimble. It takes a lot of time and planning to actually shift the navigational pattern of a cruise ship. Smaller guys like us, folks that are just getting started, can get in, they can duck and weave a lot faster. Therefore, there's still plenty of opportunity left for that smaller investor to get into the mobile home park space and make a killing in the event they choose to exit out and sell to a larger institutional investor.
Okay. Well, just so you guys know, you guys have about 1:49. You don't have to take it.
Oh, we do. Okay. Got it.
If you want to touch on any other points or expand upon anything.
Yeah, and one of the points about the debt as well. This industry has definitely evolved over the past 10 years that I've been in it. Fannie and Freddie have always been in this space, but they've really become a lot warmer, and really their interest level as far as lending on parks, and even lowering their standards, I guess you could say, not just to 5-star parks, but also to 4-star, 3-star parks, what have you. The Fannie and Freddie debt that's available, as Ryan mentioned, I mean, sub 3% interest rates, 30-year terms, 10-year fixed. It's non-recourse. That is probably one of the most beautiful aspects of the debt that's available for mobile home parks, is it's non-recourse. Whereas, and correct me if I'm wrong, guys, but I don't believe there's very much non-recourse debt available in the self-storage space. That means that you're going to be signing your name on that dotted line, and if something should go wrong, your personal assets are at great risk. And so, again, you correct me if I'm wrong there, but I do believe that mobile home parks are superior when it comes to the financing that's available. So,
and just as a final point, because we know we've got like 45 seconds left, when you follow JLL, CBRE, Northmark, they all post quarterly reports that include dispositions. And boy, wouldn't you know it, it is boom time for mobile home parks. The majority of my portfolio I've bought for at or below about 20,000 a pad. And we've seen year over year huge strides in the order of 26% plus. Now a national average is about 36.5 a door and growing. And I mean, I'm seeing places like Laramie, Wyoming, in the middle of nowhere trading for 50, 60 a door, which is just the future is up, my friends.
All right, guys. So Scott, Mike, whoever wants to kick us off here, why do you guys feel storage is a superior asset class when it comes to dispositions?
Well, the model that we've had was, at least in recent years, has been to buy these facilities and take them up to a place where a REIT would be interested in buying it, because they're the ones who have the money to be able to buy at a higher or lower multiple for us, lower cap rate, which means more dollars in our pocket. So anything that we buy, we're trying to create value or develop in that 60,000 square foot range and above. Because unlike what Ryan, the stat that Ryan threw out, our industry is really only just at 10% in terms of REIT status. And so we are poised for huge consolidation. That's what we're seeing happen right now. So there's a huge market for what we are providing to that market. Blackstone, Kevin had mentioned them as well. They just came in at one acquisition alone, a $1.2 billion acquired Simply Self Storage this year. Mr. Buffett, everybody knows who he is, and Mr. Gates also getting into the private equity side of real estate. And the only asset class they purchased, you guessed it, self-storage facilities. And so we're seeing nothing but shining faces all around the marketplace, because for self-storage, when anybody's looking at this, a hedge fund, first of all, banks, but hedge funds, any private equity markets, they're looking at the asset class that has the lowest loan default rate, and that is self-storage. Historically, over and over, year in, year out, because we do well during good times and we do very well during a bad economy. When things are good, people buy more stuff and they put it in self-storage. Occupancy goes up. When we have a time when the economy is going down, heading into a recession or during a recession, people consolidate, businesses consolidate. We have another rush to storage. Add in this COVID pandemic, and college ended up closed out quick. Everybody put their stuff into storage. Businesses started shutting down at a record rate. People put their stuff into self-storage. They had to clear out a dining room or a spare bedroom to make an office when people came home to work. Another rush to storage. And so our occupancy continues to go up. It does extremely well during good and bad times. And so there's a ton of money that is chasing self-storage facilities, because it has the highest returns and the lowest default rate compared to all other asset classes. Green Street Advisors just put out a study recently that the only other asset class that has done better during this pandemic has been data centers. That's it. So it wasn't warehouses, Ryan. It was data centers. That's it. Self-storage is in a number 2 position, again, outpacing in terms of returns all other asset classes in real estate, with the exception of data centers.
Yeah, Scott, I'll pick up where you're left off there, and I want to touch back on what some of what Kevin and Ryan were talking to, because a lot of these topics, I'll admit, are hard to separate, right? Dispositions involves financing, so it's hard to kind of put a wedge between those and completely separate them. But Kevin, I think you touched on the idea that, this logical idea that people are always going to pay for the roof over their head before their storage asset. And there may be some merit to that, but let's take it one step further and look, to Scott's point, at the default rates. Simply put, people are more likely to default on the mortgage that provides a roof over their head, like this one here, then I am, as a storage operator, statistically speaking, to default on a loan backed by my storage asset. If that doesn't tell you something about how secure the assets are and how hungry the banks are, I don't know what does. We'll touch more on that in just a minute. But Scott also brought up a great point, right? Well, let me go back. Ryan, you had mentioned Wall Street. Again, kind of bringing this idea that if you're already in the space, you're in a good position to go. But I'm speaking to the portion of the audience that is looking to get started investing. And for me, it's storage. The reason being, really, really smart people invest in this industry. Scott said it. He said, Bill Gates, Warren Buffett. I'm going to throw Scott Myers in there. I'm going to throw Mike Wagner in there. Hey, guess what, Kevin? You're coming in with me too, brother, because you also invest in this space, my man. So that's all I have on the disposition side, aside from to share. I'll use this last minute just to give you a personal example. And I'm not pretending this is true 100% across the board, but it's the real life, my experience. I want to share it. I've taken 3 properties full circle, buying them for a couple $100,000, expanding, and then selling them off. The 3 that I've sold, I have sold for between $1 and $1.5 million in net profits. And I did all 3 without a broker. Didn't have to work very hard to sell them. I was approached by the buyers. They knocked on my door, which put me in a position of strength when I was negotiating. So I was selling properties over the last 3-4 years in tertiary markets at 7.5 and 8 caps, where mobile homes in these markets are going to be at 10, 11, 12 caps. So again, that's one example. I'm not pretending that's everything. My time is up, so I'm going to turn it back over to our handsome host, Alex Pardo.
Thank you, my friend. I don't know about that, but thank you. So, guys, this is the rebuttal phase of round 2 on this position. So, Ryan, Kevin, whoever wants to kick it off, what do you want to rebut as far as anything that Scott or Mike shared with us just now?
Yeah, sure, plenty. So in this day and age, it gets testy when you have feelings versus data. But unfortunately, we do have to lean on data. And although, yes, you are correct, Scott, I have the same source on Green Street for data warehouses and warehouses. Yes, those did collect better than our space. However, making law, they put it out, my friend. Look it up. Y'all's industry is just more consolidated than ours. It's just about 10 years ahead of that. And because of that, and again, because I've actually done my research and I'm not just leaning on my feelings, it's just a better asset class in that regard. Now, it is a better space because it is less consolidated. You have more mom and pops. You have possibly better opportunities for seller carry. You can buy 5 lots and still get your start. And just FYI, 60% of my deals have come completely off market. So I also haven't gone through a broker because of that. But again, you're seeing this industry start to consolidate. Everybody seems to agree. It's following the same trajectory. We're just about 10 years earlier. So, for example, according to, because now I guess I'll just say all my sources here. According to Ralph Block, $27.7 billion poured into this space since 2011. And during the pandemic alone, we've seen well over $1 billion. So again, guys, not to make this too testy here, but feelings data beats feelings.
My bad, guys. 1 minute. You're good. You're good.
Yeah, no, and I'll speak to the off-market strategy. I mean, that's literally what we specialize in. We've bought 85% of all of our properties direct to the owner without utilizing a broker, and in turn, we have gone full cycle on a few properties and have sold them without a broker as well. So I'm not sure there's too much of a difference there between self-storage and mobile home parks. I will say that the demand is there; it's real. And the whole 10 or 11 cap mention that you made, Mike, I just don't think that's reality. I think that's very far from reality. In fact, mobile home parks on average are trading at sub-6 caps, even in secondary and tertiary markets. So the demand is real, both in core and primary markets as well as secondary and tertiary markets. And I'm pretty sure that demand is simply just outpacing self-storage.
All right, guys. Scott, Mike, so your 2.5 minute rebuttal starts now.
I can, yeah, I'm happy to pick up with a quick rebuttal. I mean, the point I want to make here is going back to the consolidation and the data, if you will. I know data is cool. I've never been able to spend any of that data at the bank, so I'm not sure how valuable it is, especially when you could find a data point to support every fact that Scott and I make and every fact that Kevin and Ryan make. It really is taking a piece of data out of context. You can decide how much value you want to put on it. I'm going to put my value where my money is, and that's what I can spend. And it always comes out stronger in the storage world for a lot of reasons we're going to talk about in the later rounds. As far as this dispositions things go, I just keep coming back to this idea that storage is an expanding industry. Yes, Ryan, there is some consolidation, but there's also new inventory coming online. So while there's consolidation happening, there's a counterbalancing force in existence. We've already, and you guys have agreed with me, that in the mobile home industry, it's simply consolidating. There is no new inventory coming online. So over time, that consolidation, that constriction makes for less opportunity for the average investor. And that's who I'm speaking to, the average investor who wants to get in. Mobile home parks, from acquisitions and dispositions, just don't have the opportunity that storage does. Here's the idea. Here's the analogy. I just thought of it. Trying to convince somebody to invest in mobile home parks as opposed to self-storage is like saying, dude, there's so many less fax machines nowadays. No one's building them. You got to buy in. Storage is the iPhone. Mobile home parks are the fax machine. You can take that and do with it what you'd like. Scott, that gives you 1 minute, my man.
That's fine. So I would state that, again, speaking from experience from where we're at right now, and that is the place where when we have projects come on board and we're putting it out there at returns, internal rate of return and our, multiples, everything is really in line with other commercial real estate asset classes. I mean, we're in the money business. We just happen to back it by the asset class that is the most desirable. And so we need more inventory for all the capital that's chasing it out there. Some of my other friends that are in the business that syndicate self-storage facilities, same thing. They're putting it out to their list. They get funded in 24 to 48 hours, and they are getting snatched up. And so, Ryan, to your point, I guess a rebuttal to a rebuttal. I didn't say that there was more opportunities in self-storage in terms of what is consolidation out there. What I'm saying is that your stat is wrong. As you said, 25% of our industry, it's only 10%. So if you're in the 7 to 8, we're really right there in the same boat, pretty dang similar. But the idea is that there's just so much chasing this asset class in self-storage because it has the lowest loan default rate. It is the easiest to run. It's the most profitable. And so when banks are looking at lending, they're going to lend on self-storage first. And that's what our hedge funds and our other investors are looking at. First of all, what gives me the greatest opportunity to get my capital back? Well, let's look across the board here. Lowest loan default rate, it's self-storage. Most profitable, self-storage. So that's why the money is chasing it. And that's why we're putting out the asset class that is the most desirable and that most people are chasing right now.
All right, guys. Hey, before we keep on and move on to round 3, I appreciate you guys honoring the time. I know it's difficult to kind of like cut in the middle of making your point, so appreciate you guys working with me on that. Guys, thank you for all the comments. There's a lot of jokes going around. You guys are awesome. I appreciate all the love, all the support. Any questions you have, now's a really good time to start firing them because we're roughly about halfway through the debate. And then we got the bonus round. And then remember, we got that 15 to 30 minutes to open it up. By the way, this is my bad. I completely forgot to mention, when you guys go to reidebate.com, you will have an opportunity to vote for whichever side/asset class you think won this debate by making a donation. The donations are going all to the same pot, all to the same place, but we'll actually be able to track how many donations and what dollar amount was donated for each asset class. So again, it's all going to the same place, but you have your opportunity to have your voice be heard as far as who won the debate. And then we'll actually see which side was able to donate more money. I wanted to mention at the top, and I completely forgot with everything going on, single family versus multifamily debate generated, or I should say raised roughly $3,700. Let's see if we can beat that. Let's see if we can get over the hump of $4,000 in donations. So Mike, I'm sorry. Did you want to say something really quick?
I was just saying, I feel like we should triple that.
If we could triple it, by all means, guys. So it's all going to a great place. So again, I want to just kind of a little bit of housekeeping, just kind of do that quick plug. You guys can vote for whichever side you think won this debate now or at the end of this, but I encourage you to wait till the end. So With that said, let me see. We started with storage, mobile home parks. So storage, guys, you got 5 minutes. We're going to move on to financing. This is a big one. Everybody's always wanting to know, how do I finance, a storage facility, self-storage facility, or how do I finance a mobile home park? So when it comes to financing, what are your guys' thoughts on what makes storage, self-storage, the superior asset class?
Yeah, and you're right, Alex. It is a big one, and I think it's a pretty easy argument too. The self-storage is, simply put, it's one of the easiest asset classes to get funding on. Banks, private lenders, sellers, simply put, they love storage because if you look at the underlying fundamentals, it's just a safer bet for them, right? They default less often. We can look, if we want to bring in data, like I said, we can always bring out the data to support our points. Out of 1,102 CMBS loans, only 5 were in default last year. That's 0.24%, right? And that's by S&P, in case you're wondering on the source. As I mentioned earlier, homeowners are more likely to default on the roof over their head than we are as storage investors on our assets, right? And again, this is all because of the underlying fundamentals. Storage is non-habitational. As a result, and we'll talk more about this later in operations, but we're under the umbrella of lien laws, which are way more favorable than the eviction and foreclosure laws that my mobile home park friends here have to endure. And when I say endure, that's being kind of nice to those processes. With that comes lower income and expense ratios. So there's basically, what this comes down to is there's a larger margin for error in the self-storage industry. It's more forgiving than any other asset class. And with that larger margin for error, that's not a secret. The banks know it, private lenders know it. And that's why it's easier for us to get financed on our deals. And this isn't just my opinion. This is backed up by the terms offered by banks. Mobile home parks, generally speaking, 70 to 80% LTV. And that's only if your park doesn't own more than a handful of the houses within the park. If you own more than a handful of those houses, they won't loan at all. On top of that, storage, we can get loans up to 90%, right? You also look at rates, debt coverage ratios, all those sorts of things. They're in the same ballpark, but if you look close enough, you'll find that storage usually has the edge. And so with that, I'm going to turn it over to Scott.
Yep. Thanks so much, Mike. And I'm just really going to we can't really say much more than we've already said, and that is the lowest loan default rate. Banks love us. Credit unions, savings and loans, community banks, the portfolio lenders. Whenever we start to see a turn in the economy, they are rushing. They are throwing money at our industry. They want self-storage facilities on their balance sheet because it has the lowest loan default rate compared to any other asset class in real estate, period. And so if you can't get your self-storage facility project funded, you're probably not trying very hard at the end of the day, because banks absolutely for that reason love this. As Mike mentioned, we can go up to 90%. We can get up to 90% funding, up to 90% LTV, and we can get that through the SBA. The SBA has 2 programs, a 504 and a 7A, that is available for self-storage, and that's because the SBA recognizes self-storage as a business. It is a business that is also backed by real estate, and the rents that come in that are also backed by lien laws instead of habitational. So you can't get those packages, those offerings anywhere else on any other asset class, period, not just mobile home parks, than you can with the SBA, and they put it on self-storage. We're the only asset class that is backed by the federal government. And so it's pretty hard to make the argument that, well, you could say whether the government is either smart enough or not. Either way, if they're putting money out, they don't do it at risk. And so this is the only asset class that they are lending on. One of the other points is that, we're an essential business. During COVID, I never thought we'd be talking about that during this time, but during COVID, we're an essential business. So we never shut down. And then also there was never, the free money that was given out or the moratoriums on evictions, because we don't have evictions. Once again, as Mike mentioned, we have lien laws that protect us, the asset and the investor. If somebody doesn't pay, we overlock them. We put a lock on their unit after 6 days, and then we auction their stuff off after 90 days. And, we are the judge and jury. We get paid every time. That's it. 100% of our late fees. You don't get that in any other asset class that has tenants and toilets and trash. And so for that reason, it doesn't matter. We can invest in red states. We can invest in blue states. We're seeing a whole lot of folks right now and lenders that are pulling out, and they're not making loans on habitational real estate in the blue states. For those of you that aren't familiar with red and blue states, you perhaps didn't pay close attention to the election, but red states. Red means right for many reasons, and blue means the other side. And that means that they get a whole bunch of free money that has been given to them. And the default rate in those states is even higher than in the red states, or those that have those laws. So Mike, we got 30 seconds. You want to add something to that?
Yeah, just in the last 20 seconds, you bring up an incredibly good point, Scott, about this government reach, overreach. Who am I to say? Long story short, in habitational real estate, the government is reaching further and further in, putting moratoriums on evictions and foreclosures. I don't know what you guys think, but I don't see that becoming less of a problem over the next 4 or 8 years. In storage, the opposite is happening. The government's taking their hands off us and letting us run our businesses the way we want.
All right, gentlemen, Kevin, Ryan, you guys have 5 minutes now. You can choose to use that 5 minutes to address anything they shared, but we're going to have 2.5 minutes for the rebuttal. So what are your guys' thoughts on financing when it comes to mobile home parks investing and why it makes it superior?
Ron, you want to go first? Or you want me to go, bud? I'll go. So, I mean, speaking to, the government-backed loans, you mentioned the SBA loans, guys. I mean, obviously, we've got Fannie and Freddie in our corner, which is hands down the best loan terms that exist in today's world, whether it be self-storage, mobile home parks, apartment complexes, what have you. Non-recourse. I didn't hear you guys speak anything about non-recourse. My understanding is that with self-storage, the majority of the loans that are made are recourse, meaning that you're signing your personal assets on the line. In the mobile home park space, that's just not the case for the majority of loans that are made on parks. As far as as far as the available financing as well, the mobile home park space is very different than what it was maybe 10 years ago. Banks, equally as much so, are tripping over themselves trying to put money into mobile home parks, trying to lend on mobile home parks. Ryan, I'm sure you probably have some data there to support this, but in any event, I don't know, there's not really so much to say about financing. I mean, mobile home parks, there's incredible financing available for them. And go ahead, Ryan.
Yeah, unfortunately, data is a double-edged sword because it's just, Alex, we probably should have skipped this section in the next one on construction, because it's just, we're going to be pulling at strings. And it's not that it's because our asset is inferior in certain regards, which it is in this regard. The financing just isn't going to be there because we're 10 years behind. We're 10, 15 years behind. And the super awesome, attractive Fannie and Freddie debt are on 4- and 5-star communities. If you're going to get you don't have parking pads, you have mostly park-owned homes, wastewater treatment plant, it is going to be harder to get that debt. However, we are 10 or 15 years behind. And I don't want to speculate about using my feelings about where this is going, but it's going in an awesome direction. So, while we can say what we want about, hey, we should skip these 2 sections, the truth of the matter is, why are we doing this beyond raising money for a wonderful cause? We're doing this because those of you listening in want to be where Mike, Scott, Kevin, and I are. We're full-time people chasing our dreams. We're so passionate about what we do. You really can't go wrong with either of these 2 asset classes. And I really hope as you're listening in, you shouldn't be making excuses. You should go and get it. And why you should pick mobile home parks in terms of a financing standpoint is if you're chasing after really nice assets, you're getting Fannie Freddie debt, which is, like Kevin said, astounding terms, amortizations, the works. And if you're not, you're chasing after heavier value add deals like I am. Every dollar I put into the mobile home park space gives me 4 in return. Plus, I make significant returns on every dollar I put in. I can do that with seller carry. I can do short-term interesting loans like construction loans and then refinance out eventually with Fannie or Freddie or CMBS. I eventually can get into those bigger and better things. But again, it's not really going to be an apples to apples comparison, because most people are just now learning about mobile home parks because we're over a decade, arguably well over a decade behind in getting people comfortable in terms of banks lending on it and all of that type of stuff. So again, the ultimate point that I want to make here about financing with mobile home parks is if you are trying to get into this space, that is more reason why mobile home parks are superior, because it's a diamond in the rough not enough people know about yet. So you can start to do some really, really cool things, and you can get in even with no money, no experience, and no network. Kev, you want to?
I think you hit the nail on the head. Yeah, I think you hit the nail on the head, buddy. Nothing else to share.
Awesome. By the way, I got to poke some fun at myself here because Ken Holmes and a few others have made some comments about my fancy cue cards. So done is the new perfect. If you guys know of any cool software where I can show the time to these guys and it looks cooler, great. But I actually happen to like my cue cards. As long as I don't screw it up. So we had a minute, so I got a little extra time. But Mike, Scott, I'm going to kick it over to you guys for the rebuttal. You got 2.5 minutes.
Before we do.
Yep.
Yeah, let's give them another 30 seconds. One of them threw out something about a 5-star trailer park. What's the difference between a 1-star trailer park and a 5-star trailer park? I just clear that up for me, will you?
Ouch. Shots fired.
Drug, sex, and rock and roll, which is where we do not invest our money, and lifestyle communities with palm tree lined streets, and a mature tenant base, and 3 swimming pools and activities directors and things like that. That's 5-star.
Well done.
You got it.
Well, don't forget that one traded out of San Francisco for like $270 million. One mobile home park, $270 million bucks. So weird things definitely happen.
Well,
all right.
That proves the greater theory once again.
I'm pretty sure, Scott, on your side, I've read articles on self-storage studies that have folks living in the units, meth labs and what have you. So you got a little bit of that as well on your side.
Save your ammo. We're gonna hop back on track here. So Scott, Mike, you guys got 2.5 minutes for your rebuttal on the financing piece.
Yeah, I mean, I'm going to be honest with you guys and just say I'm struggling right here because I don't want to rebut the concession that the mobile home park guys just gave us. We heard out of their mouths that mobile home parks is the inferior asset class when it comes to financing for a number of reasons. And so I'm not going to rebut that by any stretch. The couple things I did want to just touch on, Kevin, you mentioned the non-recourse, and I appreciate you doing that, my man. That was an oversight on our part. There are non-recourse loans available for storage investors and here's what happens. The non-recourse loans kick in, to both your points, at a higher dollar amount, right? And so the reason that most mobile home park funding is non-recourse is because funding for the smaller mom and pop properties doesn't exist. In storage, we have non-recourse available to us when we're playing in the big leagues, and when we're just getting started, we also have a myriad of options that we can tap into to fund those smaller properties.
Yeah, I was going to touch on that as well, Mike. So I appreciate that, and the fact that once again, when banks are lending on something in the commercial world, they're lending on the asset class. They're looking at an NOI. Here is, no matter what the piece of real estate is, the asset is. They're looking at the NOI, and that's what they are lending on, is this asset class. They're not lending so much on the borrower. They're looking more to the strength of the property than they are to the strength of the borrower. And so when you're looking at more the strength of the property, of course, it's individual per the individual product. But once again, when we look at the asset class as having the lowest loan default rate, it's actually much easier for banks to say yes to a self-storage facility. And so therefore, yeah, there's actually more non-recourse debt that is available on self-storage than there are on other asset classes. We choose not to use it too much. We did close on a $5 million project. It was a refinance of a $5 million loan on a project that we have that's all non-recourse. Now, we paid for that. The interest rate's higher when you have non-recourse debt versus personally guaranteed. And so when I can get sub 4% debt with recourse, and I spread the risk across a couple of guarantors, or including myself, we'll take that. If none of us want to do that, or if the deal makes sense and we're paying 6, 7, 8% for non-recourse and I can keep it off my balance sheet, off my PFS, then we'll do that as well. It is available. It just depends for anybody asking out there, wow, we want recourse debt. Well, why do you want it? I get it, but does the deal make sense? You need to match up the financing with the deal itself. And then if it makes sense for you, great. If it doesn't make sense for the deal, then move on to the next.
All right, Kevin, Ryan, your guys' turn.
Scott, I think you just made my point there. So basically, when you want non-recourse in the self-storage space, you have to pay a premium in pricing. Whereas in the mobile home park space, you actually get premium pricing with the non-recourse debt that's available. So I think he just made my point there of why mobile home park financing is better when available. And then Mike, to your point about the size of the loan, Fannie Mae has a small loan balance program. They'll do non-recourse, really attractive debt down to $1 million. So there's many different options out there, even for those smaller parks. Under that 1 million umbrella, you are going to go with a local or regional bank. But again, $1 million price point, that's where most folks are entering into our space, $1 million to $2 million. That's kind of where their the first park size is. And so even for that beginning investor, that brand new investor, there's plenty of options for them to get really attractive non-recourse financing. Ryan, want to add anything to that, bud?
Yeah, look, when I came into this, I wanted a good, clean, honest debate with some fun, with some controversy a little bit, try to rattle some folks to have a good time, and also be true to the research and the data, and not feelings about where I think mobile home parks could be in 10 years. Look, I said this before, I'll say it again, we're 10 years behind, and there are a lot of very good reasons why that is. So this section and the next section really isn't a true apples to apples for a lot of reasons. But hey, the good news is we can afford to lose this battle when we clearly are going to win the war. And to be fair, Alex, if you hadn't have done this, I mean, it would have been such a clear, easy win for mobile home parks. You got to give them a little something to keep this thing fun.
You guys are incredible. We actually got 45 seconds. So if you want to donate your time to the storage guys, that's on you. It's up to you.
Yeah, I mean, we're going to keep talking in circles here with the financing.
All right. We're good. We can keep it moving, guys. By the way, just a quick heads up. Like I said at the top of the show, no one here is losing. Everybody's winning. Who's really winning are those families in Guatemala. But Kristen Royce, who happens to actually sit on the board, good friend of mine, for Graces, about 15 minutes ago, roughly said self-storage has a very slight edge over mobile home parks in the votes currently. So any mobile home park people that are watching this and you want to support your folks, want to support your asset class, reidebate.com to vote for them and make a donation. And then storage guys, they might catch up. So do with that what you will. So let me see. We started, I think mobile home park is going to kick us off here when it comes to the superior asset class. Now, again, Ryan, I know this is probably not your favorite when we're talking about construction here. So we'll do construction, and then the fifth and final round is going to be management/operations. So for this one, let's keep it on construction. You guys got 5 minutes.
Yeah, sure. Look, everything that Mike said earlier is absolutely true. We see less than 5 mobile home parks get developed per year. So, for example, I just interviewed Ryan Gibson of Spartan Investments on my podcast. Mobile Home Parks in Real Life is my podcast, and he discussed what it took to develop one. And as soon as he finally barely House of Cards it and got it through the city council, as soon as he got it, they actually created a piece of legislation banning that municipality from building any new ones. It's tough. There's absolutely no sugarcoating that it is really difficult to build new. And a lot of times, even just infilling or developing out new pads on something that you're even zoned with is a huge pain in the butt. However, I will say there are also lots of ways you can build ancillary income through laundry, sheds, self-storage, RVs, vending machines. There are also construction loans and stuff like that you can get to develop out some things. So there are ways that you can actually go in there and build things and develop stuff out. It's just really hard. And that's generally speaking been a huge advantage about mobile home parks, is that you have a limited supply and a seemingly unlimited demand, and you're 10 plus years ahead of the game. There is a ton of money to be made in this space. At the same time, build communities, make places better, have a strong why, and make a bunch of money in the same, all in the same vein. And just to hit you with some data from Williams Research Equity, the biggest Achilles heel from my perspective about mobile home parks has been CapEx. Right? So in other words, you don't own the homes, you just own the dirt and the infrastructure. Well, you have to repipe something and it crushes you. Well, on the whole, from a macro standpoint, about 3.5% of the gross revenue on the whole for mobile home parks goes to CapEx, which is actually the lowest of any asset class, which is lower than the 4.7% annual revenue of self-storage. So there's actually less CapEx going on. So in other words, once you have these things stabled, once you're not chasing after heavy value add stuff like I am, yeah, we're not building any new, but hey, get in the game now. Don't wait. We're well behind, but that's just more room for you to get in, create legacy wealth, and do it with nothing like me. No money, no experience, no network. Kevin, what do you think?
Yeah, no, I always look at the challenge to build new mobile home parks as a benefit to our industry, right? Like, again, it goes back to the supply demand imbalance that exists in our space, and these regulatory restrictions that these municipalities put in place. It only benefits us from the today's standpoint and also future standpoint, because again, self-storage anywhere that you live, the folks that are tuning in watching this right now, I guarantee within a 5-mile radius, there's probably at least 2 self-storage developments that are coming out of the ground. I see that as a huge risk, right? I mean, we all know that the real estate market goes through different cycles. These different iterations of cycles ultimately end up in a situation where a lot of times there's going to be oversupply, whether it be apartments, whether it be single family homes, whether it be self-storage. The oversupply is what typically will crush a particular asset class. And I see that as being a huge risk with self-storage. I mean, there's just really no controls in place to keep one of the larger operators from coming in and absolutely just crushing the little guy, building larger state-of-the-art facilities, putting more dollars behind their ad spend budget to basically crush the smaller operators that are in that space. And as far as mobile home parks as well on the construction side, one of the big benefits that exists in our space is when we're buying a mobile home park, we're typically just underwriting that mobile home park on the total number of existing lots that have occupied paying tenants on them. And very often what you'll find in the mobile home park space is that if you've got a 100-space mobile home park, very rarely are 100 of those lots occupied. In addition to that, a lot of times there's additional land, as Ryan had mentioned, that you could expand upon. But back to the point of those vacant lots, most of the time we're paying little to no dollars for those additional vacant lots that already have infrastructure in place. And so it's very easy upside, very, very easy to add, double, triple the value to any mobile home community if you're buying it based on the existing income that's in place and then have empty lots to infill. So huge benefits there.
You're good. 8 seconds. So we'll kick it over to the storage guys.
So
we're talking construction here. So superior asset class, self-storage. What are your thoughts?
Yes, it is. You want me to go on?
Please. that was a question, by the way. I remain neutral. That was a question, but go ahead.
You're just handing it to us. So, this is my 3rd recession that I've been through, and 2nd being in self-storage. And so when Lehman Brothers fell last time out, banking shut down. The faucet was shut off on commercial finance and especially speculative, meaning development. Banks, they'll look at existing asset classes, any type of real estate, historical financials, show me what it's done for the past 5 years. I can lend on that maybe. Come in, Mike and I walk into the bank's office and say, hey, we got this piece of dirt. We're going to put self-storage facilities on it, and it's going to produce X amount of income, in 2 years. They're going to say, well, we're not doing that right now. We're going to wait. So the good news is that as we come out of that recession, the demand, as we know, self-storage is better during a recession because of people are downsizing, businesses are downsizing. So we have this huge pent-up demand for self-storage, and the financing was shut down. Well, then all of a sudden, 3 or 4 years later, 11, 12, we started constructing self-storage again. And at a time when occupancy was in the mid-90s. We still have not caught up. There are areas that are close to equilibrium, but we are not at the place right now where industry-wide, we're at 91% occupancy nationwide. And in self-storage, and in most commercial asset classes, but in self-storage at 85% occupancy is when you're reaching equilibrium, meaning at a facility, meaning that I'm going to be out of some 5x10s or some 10x10s. I may have to move them in somewhere else, but at 85%, we're looking to expand. And so as an industry, we're at 91%. So these folks are full, they got waiting lists, and these are in the top 100 metropolitan statistical areas. And so to Kevin's point, and I know it's not a rebuttal, but we everybody's always scared that what happens if the big guys come in and do this and squeeze out the little guy? Well, the big guys, we've got 2.2 million square feet of self-storage. We've got 40 facilities located all across the country, 13,000 doors, and 80% of all those are new development in the past several years. We've got 6 coming out of the ground right now. We don't do it for kicks. We don't do it for fun. The days of build it and hope they come are long gone. We do feasibility studies. We hire consultants. We have software. We're boots on the ground. We know what's going on in the market. We're not going to put a facility in an area at our market that is oversupplied, nor is anybody else going to come in and see whether we are a little guy or anybody else and say, wow, this market is oversupplied by 7 square foot per capita. Let's go throw a facility in anyways and just see if it works. And we'll take a chance and we'll lower rates to the floor and devalue our own facility and put everybody else out of business and drive the entire market down along with it, including the value of our facility. So that's not realistic. And I'm being facetious, Kevin, but you know what I'm getting. So that's not a big a risk because everybody's going to do this, look at the same data. And if it's oversupplied, they're going to move 5 miles down the road and look at something else. So I think that's about all I think I wanted to hit on that piece. So Mike, I'll go ahead and turn over to you.
Yeah, and I'll just speak to the other side again from personal experience, what I've seen in the construction side. I'm going to tell you, I bought my first facility in 2011 for $330,000, 40 grand out of my own pocket that I extracted out of some duplexes. So getting in as a small investor, whole lot easier because our asset class doesn't start at $1 million on up. Now that doesn't mean the profits are any smaller though. Over the course of several years, I improved that facility. I tripled it in size. So I added 20,000 square feet to it. I had never built a doghouse before I took on that construction project. I had no business doing it. But the thing is, you have 3 or 4 tradesmen. You got somebody to move some dirt and lay some concrete. You got a metal building that shows up on a truck and they put it together in 4 days. Start to finish, it can literally be 2 to 3 weeks, right? And so clearly that shows how an idiot like myself at the time could do it, how quickly it can come together. And let's now talk about how profitable is it, right? I sold that property just a couple years after I finished the expansion. I sold it for $60 a square foot. My cost to build was $20 a square foot. So I tripled the money on a construction project that took 3 weeks per phase, right? You can't do that in mobile home parks. You're fighting City Hall, right? You're building on a house of cards, I think were the words that Ryan, my good man, used. And it just can't be done. In storage, it's easy. I did the same thing. That wasn't a fluke. I did it at another property. And I kid you not, talking about fighting City Hall, I got approvals to almost double, from 15,000 to 24,000 square feet. So not quite double the size of a facility and build out with a site plan that I bought from www.mysiteplan.com for $129. Tell me when you've done that with a mobile home park, my friends. We're good.
All right, gentlemen. Ryan, Kevin, you guys got 2.5 minutes for anything you want to rebut.
Yeah, my very first mobile home park, still own it today. We're actually in contract to sell it. And so I want to make sure that everyone knows that it is very accessible for the smaller investor. I paid $200,000 for that mobile home park, a 34 space park in Atlanta, Georgia. We've owned it since 2012. In contract to sell that property right now as we speak for $1.25 million. I made my money back on that deal from cash flow in just 2.5 years, pure cash flow, got my original investment back. And so you guys can do the real quick math there as far as the total return. I mean, it's infinite. And so again, I want to speak to the opportunity for the smaller folks to get into this business. And I mean, when I met Ryan years back, he was that guy. He was that individual that was entering into the space with very little money. There's a ton of opportunity there for that smaller guy. Ryan is proof in the pudding. I mean, literally that opportunity still exists. They still exist today to make big dollars in our space.
Yeah,
Ryan?
I want to second that. Mike, I didn't know that about you. I had $30,000 to start out too, and I had 60 in student loan debt. So negative. Look, it comes down to this. Like, if you want to look at the data, if you can get those seriously compressed cap rates, if you can increase annual yield just by 2 to 3%, you can increase the property's value by as much as 50% in this space. 10 of the 17 mobile home parks that I will have bought, because I'm closing on one today, were bought sub $1 million. And arguably, because in my personal opinion, it doesn't matter what someone thinks it's worth. It's not until someone shows up and writes a check that you really truly know what something is worth. I don't think there's a single property in my portfolio that is worth less than $1 million right now. So look, I mentioned earlier, every dollar I put in becomes $4 when stable. Not to mention I'm hitting a serious cash on cash return. All of this by literally quitting my job, moving into a mobile home park, making massive sacrifices to do it. And the only reason why I wanted to do that is because I wanted to grow bigger and faster. If I just wanted to take my $30,000 and buy one and then slowly grow, I could have done it. But I hated corporate America. I was stuck. I wanted to do something bigger, better, and help people along the way. And so my journey took me that direction. And Kevin, as he mentioned earlier, was one of those people who helped me early on. There's a lot of great people in the space like Kevin and I who are willing to help you just because. So mobile home parks, let's go.
Ryan, I forgot you lived in a mobile home park.
It was the one right by that one you're talking about in Lovejoy.
I know.
All right. Mike, Scott, why don't you put a bow when it comes to, go ahead, to construction here.
Yeah, so to rebuttal, to start my rebuttal, Ryan, my favorite thing about you now is, dude, that you moved into a mobile home park to make your dreams come true. For everybody listening, y'all got to take some of that medicine and do it.
Yeah.
That's awesome, brother.
Thanks.
That being said, I'm still going to pick both of you guys apart on some of the rebuttal here. Ryan, I think it was you that mentioned the CapEx, needing a higher CapEx in storage versus mobile home parks. And I'm going to be honest and say that may very well be true. I don't know, because I'm not focused on the little battles. I'm all about the war. And the war is income to expenses. CapEx is one expense. When you add up all the expenses for each of the two industries, the income to expense ratio in storage is less than in mobile home parks. So maybe for CapEx, that's the one where we're a little higher, but who cares? We're looking at the end of the day, and income to expense comes out on the side of storage. The other thing, I know, Kevin, you mentioned, and a very valid point, and I love it. And I want to be clear, guys. I think we all know this. Making money in either of these two asset classes is 100% possible and doable. They're both great. It's just about which one's more efficient. And Kevin talked about buying a pad or a facility, a park with vacant units. Well, we do the exact same thing in storage. Scott could tell you, we don't buy the empty units. We buy the income of the full units. And so all of the value add by adding pads in a mobile home park is available to us in storage units in the same or greater proportions. The difference being we don't have to fight City Hall to get a new home put on there. We don't have to unclog the toilets if there is a home there. We just sweep out the unit, hit the button on the internet, puts our website live, and people start moving in and moving out while we're sleeping. The fact that there's more turnover in storage means nothing because we're not involved in it. People move out and they move in 24 to 48 hours later without us having been involved. We'll talk more about that in the next round. Scott, excuse me, I want to leave the last 45 to you if you have anything.
Yeah, and it was really about the same. Interestingly enough, Mike, I wrote down the same things that Ryan, you mentioned about the CapEx, and I was going the same place with expense ratios. 40% is the average income to expense ratio in mobile home parks, and it's 31 in self storage. So it's actually less. So when we talk about getting into the nuts and bolts of it in terms of CapEx, well, we do have moving parts, and we got buildings where you have pads, and then but your expenses are higher because when somebody leaves and they've got that shell of whatever that mobile home, that trailer, you've got to haul it away, and so there's an expense involved in that. When it comes to let me take a step back, Alex, and let's just touch on this. We're all educators here, and so the point that I want to make clear is maybe a little different direction here is the beautiful thing about commercial real estate. And when we're buying a mobile home park or a self-storage facility, especially what we're looking at now and in the beginning is we try to buy everything value adds. We're trying to buy an existing facility that has extra land. We have buildings on 4 acres and it's a 5-acre parcel. Kevin and Ryan are looking at a mobile home park that it's got pads on 4 of those 5 acres, and they can expand when they fill them up. And since we're financing it and doing our evaluations based on the NOI, the net operating income in place right then, it means that we had an acre for free. Use whatever example you want. And that's how we created the millions in this business of ours in the very beginning, which then catapulted us into getting into developments and bigger pieces. So I guess for everybody out there, always be looking for value add, looking for ways to be able to create value when you close on that facility or that mobile home park in the beginning. And for gosh sakes, please get some help, get some mentoring, get some coaching, and understand the underwriting and the financials before you go out and make a decision on any one of these asset classes, because commercial is different, especially when you folks are coming up from single family and you're looking at a valuation based on an appraisal versus an NOI. There's an art and a science to that, and it takes a lot of years to really master it. And we're always still learning, but it still takes months before you really can wrap your head around it and move from that space. So I just want to make sure that everybody's clear that it's an incredible opportunity when you get into commercial real estate to have that power, but also it can work against you if you don't know what you're doing. So please make sure you have a mentor, somebody come alongside of you and help you underwrite either asset class that you're going to invest in.
Yeah, no, I appreciate you sharing that, Scott. And we went over time, but I think that's a very neutral and fair point that everybody would double down on. You know, regardless of what you do, whether it's commercial or whether it's single family, get educated, invest in yourself, align yourself with the right people that can help you, because especially in commercial, you know, I'm sure you guys will agree, one big mistake can really hurt you if you don't know what you're doing. So make sure that you have a coach, a mentor, a mastermind group. Just align yourself with the right people that have been there, done that. So appreciate you sharing that. I think it's a fair point, regardless of what asset class we're talking about. So having said that, we are going to wrap up. Actually, we got a bonus round, so we're not quite ready to wrap up the debate. But round 5 here, we're going to be focused on management and operations. Okay, so storage. You guys are going to kick us off. Self-storage, Scott or Mike? 5 minutes. Give us your best as to why you feel self-storage is superior, better, whatever you want to call it, when it comes to the management and the operation side of the business.
Yeah, I'm going to do my best to sneak in. Scott and I are to sneak all these advantages in under 5 minutes. But this is really where the rubber meets the road and where storage emerges as the clear-cut winner. And what it comes down to, I think the overarching umbrella here is that storage operators don't have to rely on a very unpredictable resource known as people. No offense to any of us. We're all that. But there is an unpredictability within us that causes problems within every real estate investing operation in the world. And so it's not that we don't have to rely on people to some extent, but what we want to look at is how mission critical are the tasks that we rely on our people to do. And storage just has the opportunity to automate far more than you can in mobile home parks. And the things that are left for people to do are not mission critical, right? They're sweeping units and they're cutting locks. It's very low level manual tasks. It's not judgment and essential soft skills like figuring out whether or not somebody is credit worthy or has the right character to move into our park. And so for that reason, storage starts to take a lead. But the other thing is we're not dealing with habitational real estate. So from an operation standpoint, when someone goes delinquent, we're talking about getting them out and getting that unit re-rented in a matter of weeks from when they default. Whereas if you've ever experienced evictions or foreclosures, you know we're not talking about weeks. We're talking about many, many months and even into years sometimes in the worst cases. So again, that adds to income, the storage's ability to keep income to expenses so low. The other thing I can tell you is Ryan mentioned ancillary income. Funny enough, he mentioned it as a mobile home park operator. He mentioned using storage as ancillary income, which I found very interesting. We do the same thing, except storage operators stay within our realm of storage because that's the best place to be. We add tenant insurance and admin fees, even though there's not really any administration. We get paid for nothing because the computer does all of it by itself. People move in and move out literally on their phone in our parking lots without ever talking to us or interacting with us in any way. And so from an operations standpoint, storage is the clear front runner here. I'll just share personally, I run currently only 2. Again, I'm a small volume investor. It's been as many as 5 facilities, and it takes me approximately 1 to 2 hours per week to manage those properties for the tasks I do. Mostly done from my phone or email, just texting, handling the occasional thing that needs to be handled, but 1 to 2 hours a week to generate all the money that my family needs to pay all our bills and live on the road for 6 months a year. So it's not only that storage is better at making money, but it's an easier way to make money. So Scott, I'll kick the rest of the time over to you, my man.
Sure. That's why we have a lower income to expense ratio, because the highest line item expense in any business is payroll. And, when we can operate and we have 80% of our rentals come from this, 80% in our industry of our rentals come from this. we have a website that is responsive, which means that it responds to whether somebody's on their laptop, an iPad, or a phone, and allows them to not only reserve a unit if they want to, but they can rent a unit and pay rent online. We have several of our facilities that are unmanned. This is a low labor intensive type transaction. We can gather all the data that we need and feel safe enough to move somebody in, because like Mike said, we don't have to interview this person. And also, by the same token, we know that it's typically mom is the person in the household that is tasked with getting this storage unit. And so what she wants to do is, it's a commodity for her. It's something to check off her list. And if she can go to a website and see a picture of our facility, multiple pictures of our facility on the website, and she can see the ways to move in, that it's clean, it's safe, it's secure, it's well lit, the pricing and everything is there, and she clicks some buttons, that's one less thing for her to do during the day. She's not looking at school systems and neighbors and anything else. She needs a box to store her husband's junk in, and she wants to check this off her list. And the transaction is no more intensive than basically going to a Redbox rental. And we're secure. We got their credit card. It's their stuff. If they don't pay, we lock them out and then we sell their stuff off. So we don't need to go through all of those other management intensive types of duties and tasks that a manager would have at a habitational type real estate. Mike also touched on the ancillary income streams. There's over 40 ancillary income streams or profit centers we can add in a self-storage facility to boost the NOI with very little to no investment on our part, that we can add to a facility depending upon where it's at, from record storage to even propane. If you have a large boat and RV lot, we have those filling stations that have kiosks in it, so we don't have to mess with those. We have vending machines. Just many ways to increase the income. And then at the end of the day, once again, we don't have the habitational laws. We just have lien laws that protect us. They don't pay, we lock them out and sell their stuff.
Kevin, Ryan, what do you guys think?
You want to kick us off, buddy?
Yeah, sure. I think it's this concept of can be versus is. So, like, Mike, that is so cool, and I didn't know a lot of that what you said, and I'd love to connect offline about more about what you guys do. I think that's wicked cool, and vice versa. Most of my business is automated as well. You have to have a human review the application. You just do. You just do. Humanity goes so much more beyond a credit score or a criminal record or an eviction filing, right? So, in that regard, there's definitely a one-up for self-storage. However, I think like this concept of it being heavily management intensive it's just not accurate. Again, it can be versus is. Now I do heavier value add stuff, so a lot of my stuff is a lot more intensive because I'm chasing after that type of stuff. And just going across my own portfolio, the highest expense ratio I face with private utilities in the middle of the turnaround is about 45%. So in other words, every dollar that comes in, I'm spending 45 cents going out to fix in probably the worst case scenario. Best case scenario, I'm at about 25% on a really small property. So as that gets bigger and we raise rents, that'll in some cases go sub 20. So again, it comes back to can be versus is. Rent can be 100% automated. Late fees as well. People can pay online. People can cash pay at a Walmart. I don't have to touch anything. I actually can set up an auto text to let people know that they are late. So I don't actually have to do that. Again, the one big piece of this is I do and always will check my own applications myself and have employees do that. But again, the average tenant stays for 14 years. And in my experience, even with that really low turnover, the folks, generally speaking, sell to someone who's just going to take over rent. And if you look at P&Ls, it doesn't skip a beat. So vacancy loss is extraordinarily low for that reason. But again, it all comes back to this, can be versus is. And if you focus on mostly tenant-owned homes and you've got the right people in place, especially if it's direct build utilities, you're pretty much collecting rent. And then you're pretty much so just doing the right thing any investor should be doing, which is going to your property, talk to your residents, understand the people who are consuming your product. What do they like? What do they not like? How can you improve it? What other ways can you make money? That's what a business person does. And then not only that, you can bolt on acquire properties. So one thing that I've done, because I didn't have a lot of money, is I'll buy like a 25 lot park, and then something will happen. And then all of a sudden I know all the local folks, and I bought a 60 lot park, and then in another 30 lot park. And for example, in Gaston County, right outside of Charlotte, I have 175 pads. Not one of those properties has more than 40 lots. So, and I have one employee for all of that. It's a pretty special thing, but again, it comes down to can be versus is. I have very sticky employees. I have very sticky residents. People, if they're not going to default on their home, because for most people, that's their most valuable asset. So, yeah, I mean, really, my time is spent mostly in rent week. And that's really it. Otherwise, the rest of the month, I work on my podcast. Like Scott mentioned, I coach because I want people to get into this space for the right reasons. And I want to echo everything Scott said. It was absolutely wonderful. So then I can focus on stuff like that, like my charity work. So, and then one other big piece of it is price inelasticity. Because we're so late in the game in terms of having artificial intelligence come in and actually, like in self-storage in a lot of cases, give you an optimal rent amount. This is like Billy Bob's mobile home park felt like the rent should be $200. Well, that's not necessarily the case. So the price inelasticity is very different in our space, which leaves a lot of upside and also allows you to bring in some awesome residents. Kevin?
Yeah, no, and I just want to start by saying that, self-storage, mobile home parks, they're both wonderful asset classes, but it's not the only two ways to make money, right? You can make money in just about any asset class, right? So those that are watching, I think you've got to really focus in on which asset class is best aligned with you, your personality, your ultimate long-term goals, what have you. And it might not be either one of the two that we're talking about today. As far as the management side of mobile home parks, Ryan, you hit on a point of the longevity of our average tenant, 14 plus years. The beautiful thing about mobile home parks, that happens when something actually does turn. When we get a unit turn, we very rarely ever have any downtime, because what happens is that tenant puts their home up for sale. Maybe they have to move for a job relocation, or just maybe they're moving closer to a son or a daughter, what have you. They put their home up for sale, just like you would a stick-built home. They put that home up for sale. They continue paying that lot rent. New owner buys that property from them, assumes that lot rent responsibility. You don't have that, that the week or two or month or two downtime when you're not receiving any revenue from that particular property. It literally is just seamless all the way through. It's an absolutely beautiful thing. In addition to that, with these tenant-owned homes, you find a very deep pride of ownership that exists. In fact, we have a number of communities that I may not go as far as saying they self-police themselves, but they do, because these are literally homeowners that plant flowers outside their homes. They take care of their units. They look after their neighbors, and they view their community as a neighborhood. Sorry. Go ahead. I'm getting cut off here, but it's very, very much akin to a coupon clipper type of investment. And again, a lot of the automations that you guys have, they do exist in our space as well.
You're good. We'll give the storage guys a little bit of extra time if they want it and they want to.
Yeah, fair enough.
Mike, Scott, why don't you guys take us home with your rebuttal on the management piece here? I'm sorry.
Sure.
Management operations piece.
Yeah, just to rebut some of what Kevin was saying, I think a lot of it's true, right? That the part about the self-policing that he got cut short on there, I believe that to be true for tenant-owned homes. But what's happened here is our mobile home park guys have failed to mention the ugly duckling in their industry, and that is park-owned homes, and they are just a train wreck. I don't have experience in the mobile home park, so I'm going to speak to the stories I've heard from people who talk about speaking to Ryan's point about can be versus is, mobile homes can be awesome if you don't own a single one of the houses, but that's not possible. It can be, but not in the real world. Every owner I know, and I know some that own very big portfolios in the mobile home space, say that it's just not realistic. So you're going to have that. So the point being here that while you may be able to do some automation on some parts of the mobile home park, that automation falls apart for a portion of the customers that they serve. And so, yes, storage and mobile home parks can both be automated. Can be and is. Which asset class is automated with greater ease. I'm going to say that that's storage beyond a shadow of a doubt. One, because we don't have any park-owned units in our our storage facilities or facility-owned units, and we don't have any uncontrolled expenses. Right? Those park-owned homes bring uncontrolled expenses. Sometimes utilities aren't metered the way that the park owners wish they could be. Right? The can be versus they can be separately metered, but they're often not, and sometimes it's very hard to get them separately metered. So, Scott, I'm going to turn the rest of our rebuttal over to you.
Sure. Yeah, our expenses in this, this is self-storage has been said that it's a very simple, predictable business model. It doesn't mean that it's a simple, easy business because none is. And if people treat it that way, they're going to find themselves in trouble. But it's a simple, predictable business model. For buying Class C facilities, we know roughly what the averages are, nationwide averages, and then our own that we know coming into a facility what we can expect, and we know where we can take it roughly. And that is one of the misnomers. I began looking into mobile home parks when I was making my transition out of homes and apartments. And I know some guys that were very big into mobile home parks over in Illinois. Ryan and Kevin, you probably know who I'm talking about. Owned massive amounts of parks over there, and I went over on a fact-finding mission to see if this is something I wanted to do. And at the end of the day, there were so many unknowns. And this is when Conseco and the financing dried up for the financing of mobile homes. And then they became park-owned homes. And then it once again, it got me back into the place where it looked like I would end up being a landlord and owning these homes and trying to finance them myself on some kind of rent-to-own. Whereas with self-storage, it's a metal box on a concrete slab. We buy it once, and when we need to turn it, we blow it out with a blower and move in the next person waiting in line. That's it.
Yep. Kevin, Ryan, why don't we wrap up round 5 here, and then I got something I want to share with everybody. So, guys, make sure you're tuned in. By the way, I appreciate everybody sticking through an hour and 45 minutes into this thing. We're going to be wrapping this thing up. Round 5 is not going to be quite as long as these, and I'm actually going to call an audible and switch it up a little bit. But Ryan, Kevin, why don't you share your thoughts on the rebuttal when it comes to the management side?
Yeah, sure. Look, I have a lot of park-owned homes because I take mostly heavier value-add opportunities. Even still, less than 20% of my portfolio is park-owned homes. And even still, when you have back-due maintenance, about 33% to 50% of the additional revenue that I get, and again, this can be versus is because I only have data on that I trust that is my own. And so 33% to 50% of the rent I make above the lot rent itself on a park-owned home goes to the expense. So when it is done right, a park-owned home is an absolute wonderful thing to do. I run a bit of a hybrid model. You can also sell them off. You don't necessarily have to do rent to own. You can also partner with local construction workers. You can do all sorts of stuff to ultimately make that a tenant-owned home. But it comes down to this: what strategy do you want? And I want to just second what Scott said earlier about having a mentor and educating yourself, because there's a lot of different ways you can go and you can really burn yourself no matter which of these two asset classes that you pick. Ideally, you're 100% tenant-owned home. Is that impossible? Absolutely not. I know plenty of folks who are effectively 100% tenant-owned home. And occasionally, they will get a tenant-owned home back, but then they'll broker the sale and be done with it. So you are not beholden to park-owned homes. Can they be disasters? Yes, if you don't have infrastructure set up. But it's really, to be honest, not overly difficult to set up. It's actually pretty lucrative, spawning a lot of people who get into it just for the park-owned homes. Kevin?
Yeah, no, in our portfolio, it's made up of about 20% park-owned homes. So we do have quite a number. We have many communities where we have 0 park-owned homes, and in others where we have more than that. But really, backing up here a little bit, I think a lot of it really comes down to your management ability and your ability to actually build a sound infrastructure. Hiring the right team members. Building the right team to oversee the management of these assets. I can tell you that although we have 200 plus park-owned homes, it doesn't change how much effort on my side throws into the equation each and every week. So I'm not busier because we have 200 park-owned homes versus having 0 park-owned homes. And as Ryan mentioned, it's a very lucrative part of our business. In fact, we have a number of communities where we can ultimately mark up homes by 50%. And it's an additional profit center. So we can get cash buyers and literally make additional revenue streams by selling those park-owned homes for a markup. So anyway, it looks like we're out of time.
Yep. So guys, I really appreciate you. I want to kind of take, before we go on to this bonus round, which we're going to make 2.5 minutes, no rebuttal, just 2.5 minutes each side. In the sake of, for the sake of time, I want to be respectful of these gentlemen's time and your time watching wherever you are. I just want to, hopefully you guys, the audience, you guys watching, whether it's in the podcast in the future on Facebook or if you're live, hopefully you allow me to kind of speak on your behalf. And I know I speak for myself, just the level of gratitude that I think we all have for you guys being so giving of your time, of your knowledge, of your experience, for opening up and wanting to support this cause, and for doing this and just having a lot of fun with it. I think it's very obvious how much each and every one of you guys have prepared for this debate. I mean, you guys are bringing it, all four of you, both sides. So I just genuine thank you and appreciation, not just for me, but I'm sure for everybody watching this. There's been a ton of comments. Adrian just threw out great stuff. I mean, so many people have just been pouring in with comments how much they're appreciating this. And I give all that thanks to you guys for being the experts and for being the thought leaders in your space and for impacting people's lives in a positive way. So just wanted to get that out there. Here's the bonus round. I'm going to call an audible. The bonus round was going to be around cash flow and wealth building, legacy wealth. You guys have all articulated very well why either side, either asset class can accomplish that goal. And I also realized that I've kind of pigeonholed you guys into these 5 rounds, right? And so I want to give you guys the opportunity. We're going to start with mobile home parks, to share anything maybe that didn't fit within one of these categories that maybe we haven't spoken about, that you want to share for anybody out there listening that's considering or thinking about mobile home park investing. So this is kind of going to be general and open-ended. Anything that you guys might want to talk to, it could be a previous point you've already alluded to, or it could be something that maybe you haven't had the opportunity to share just because it hasn't really fit that particular category. So speak specifically to someone who might be considering mobile home park investing, for cash flow and for wealth building purposes.
As I mentioned, I think it expands much greater than that of just self-storage or mobile home parks. There's, again, a million different ways to make money in real estate. I think really what you have to do is spend a majority of your time. If you're just getting started, you need to spend a majority of your time figuring out which asset class is the best fit for you. Again, you can make a ton of money in self-storage, make a ton of money in mobile home parks, office buildings, industrial buildings, retail. Maybe not retail today. I'd probably stay away from that. At least for the time being. Hotels, probably stay away from that one as well. But ultimately, you can make a lot of money in many different ways. But you got to pick that asset class that is best aligned with you and your personality. There's different aspects of mobile home parks that might be more time intensive or management intensive, and vice versa with self storage. But pick the best one that aligns for your overall interest and your overall goals. I think we hit a lot of relevant points. Mobile home parks have been just a godsend to my family and I. They produce incredible amounts of cash flow, very significant double-digit returns. We've got a number of assets that we still own today where we're getting 30 and 40% cash on cash returns, which is absolutely ridiculous. But again, I'm sure you guys have the same type of stories in the self-storage space where you've achieved similar results as well. But Ryan, I don't know if you'd like to add anything here, but I think they're both incredible asset classes. You guys have been a lot of fun to debate this with, and I think that anyone listening will find a good opportunity in either asset class.
Yeah, Kevin, well said, man. And Mike, Scott, very humbled and honored to be debating against you guys. I hope you understand, like, I was saying certain things to poke you guys with the stick, but made it fun, right? So look, a couple quick things. My why is the biggest reason why I'm here. You can make a lot of money, but guess what? If you don't have a good, strong why, you're going to quit when things get tough. And I'm sorry, but the ace I've been holding in my back pocket this whole time is there are resident after resident after resident who tell me they want to die in my mobile home park because they love it so much. They take that much pride in ownership. I don't know a single person, and maybe I'm wrong, but I don't know a single person who's like, man, you know what? Where I keep my golf bags and old gym equipment, boy, that's it, man. I got so much pride for that little storage locker. No, this is where people live. I got started with nothing, no money, no network, no experience. I watched my son be born prematurely, which was the scariest thing ever. And I didn't have to worry about PTO, and I didn't have to worry about getting passed over on a promotion. You can do that in self-storage too, but y'all, it is a dream worth chasing. That is real estate ownership. And then the last point that I have is, let's be honest, guys, Trailer Park Boys is such a much more fun show than Storage Wars. So if nothing else, y'all, Mobile Home Parks wins.
That's hilarious. That's it. You guys are awesome. Mike, Scott, final parting or closing words here. 2.5 minutes. Anything that maybe you want to share that maybe hasn't been covered, or just I'll kick it over to you guys for whatever you want to open up about.
Yeah, well, I'll continue on the same path, which is what I was going to state anyways, that Kevin started us on, and that is, there's everybody says, I think it was Confucius that's given credit for this. He says, find what you're passionate about as your life's calling, and you'll never work another day in your life. And that could be true, except for the fact that how fired up can you get about metal boxes on concrete slabs, and so I've kind of taken a little different stance in that. And this is one more tool to add to your tool belt of investing in real estate or in business, or a way of getting you, as Ryan mentioned, out of the rat race and out of corporate America. These two asset classes, let's face it, and you all can go find the stats yourselves. The hedge funds, the private equity, they're chasing these two right now. They're chasing these two. So we should have one where we go up against the single family guys in the apartments, and we totally crush them. But that's because these two are the most passive, and has created a lifestyle for us. Mike's been able to go out, and he's got an RV, and he travels 367 days a year to go all around the country with his kids. We homeschooled our kids and our family, and we were able to raise them because we achieved the E-Myth in this asset class, and that is we manage and tweak the system. The system runs the business, and these are both two very low labor intensive types of asset classes. So go out and find what it is, which asset class that really maybe fires you up. But I would say it doesn't have to fire you up, as long as you find a business or something that the numbers make sense, and then that allows you to go do the things that you want to do. So sorry, I ate into my space there.
No, that's all right. I agree. Your business has to fire you up if you're working at it 40 hours a week. If it only takes an hour or two, you can make it happen, and then go fire yourself in any way you want. But I want to echo these guys' comments. Scott, Kevin, Ryan, Alex, thank you for doing this. Honor to be here with you guys. What I heard, I think, and the take-home message is that either of these assets can make you money. I don't think I need to kick that dead horse. Toward the spirit of winning the debate, which I think is we're all going to come in second place to Grace's when we see what those total donations come into. But because of my loyalty to storage, I need to just say that I feel like Kevin won the debate for storage with his last couple comments. And to his credit, he was talking about building sound infrastructure and building a team and having an organization. And those are skills that he is incredible at, and he's used to profit. But that's not what we're debating. We're not debating on, if you build a giant machine, what's the better asset? Mm-hmm. We're just debating which is the better asset. And I would argue the one that doesn't require a machine to give you the life that you want is the one that you should be exploring.
Yeah. Well said, gentlemen. Again, I echo everybody's just appreciation and gratitude for you guys opening up and sharing. So, guys, what we want to do here is we got 4 minutes. Are you guys okay if we just go an additional 10 minutes on Q&A? I really want to be respectful of your time. Does anybody have to do a hard stop? Okay, cool.
Good.
So we went, obviously there was some housekeeping, so that ate up a little bit into our Q&A time, but you guys have been firing a bunch of comments. Some of these comments are just having fun and participating, so just let me see if I can find some questions here. There's a ton. It's kind of hard to choose. If you guys have any questions in the meantime, go ahead and fire them away. Let me see. I'm kind of on the spot here, and I'm searching for a good question.
Hey, Alex, while you're looking at that question, can I just emphasize Ryan's point for your audience? The starting with the why and the vision is hands down. If you're not an investor yet and you're thinking about it, stop where you are and don't start until you explore the question that he so eloquently conveyed, because there are all of us on this panel can point to real estate where it literally gave us an opportunity to experience something in our lives. Ryan shared a very vulnerable example that you can't put money on. And so if you're just doing storage right now because there's a lot of money at the end of it, my caution is listen to Ryan, stop, dial in the why, because you'll make money faster if you do that anyways, right?
Yep.
Yeah. By the way, guys, I want to just go ahead and put this out there. There's been roughly $720 that have been donated. I'm going to match that. So I'm going to put whatever it is, $720 of my own money. We got some work to do here as far as the donations, guys. If you're not able to donate, share this with somebody. Share this, because the more eyeballs that we have on this, and I realize that we're live here, and so donations will continue to come in over time, and this is going to be evergreen, which is awesome. But let's see if we can beat the single family, multifamily donations that have come in. And trust me, these families live on, I think what they shared with me from Grace is $186 a month for a family of four. Mike and I have actually been to Antigua, Guatemala. I know Scott builds houses in Mexico. Many of these families live on dirt floors. Like, it gives me chills thinking about it. So if you guys can donate 5, 10, 20, 50 bucks, it goes a long, long way. Trust me when I tell you that. So head over to rdidebate.com. I'm going to match the current donations that are on the board right now. And so questions. All right. Now that we've gotten that out of the way, Anthony Kusky, my good friend, what is the minimum loan for an FHA loan on a park?
An FHA loan. Not familiar that there. I didn't realize that there actually was an FHA loan. Ryan?
I have an FHA loan on my house.
Yeah.
I don't think of Fannie Freddie.
Yeah. If you're thinking of Fannie Freddie, then Freddie has a small loan balance program that will go down to $1 million. They get a little bit more critical of the location, the market, the quality of the park, what have you, in that smaller loan balance program. But we literally have one right now in a park that we own in Kentucky. That the loan amount is $1.4 million. So it fell into that small loan balance program. So $1 million threshold.
Okay, got it. One more when it comes to the financing, Philip Silver, will SBA loan on mobile home parks?
That's a great question. I don't believe so. Ryan, are you aware? I have not heard of any SBA loans for mobile home parks. You?
I want to say that I have heard rumors that it's been done. I personally haven't looked into it, and I don't know anyone directly who's told me they've done it. I don't want to say it's impossible, but it's definitely uncommon, if not rare.
Yeah. The most common options, obviously, you've got banks, you've got local regional banks, credit unions. There's multiple different CMBS lenders that are in this space. And then you got Fannie and Freddie. And I do believe that the USDA also has a few niche loan programs for rural type communities, but those are the only ones that I'm aware of.
Yeah, I think the SBA has a thing against any habitational real estate. They even, when I got a loan for a facility, it had apartments, residence quarters on site, and that came up as a potential issue. But I think that part of it comes into play.
Yeah.
Okay. Guys, last question, just for the sake of time. But before I kick off this question, I just want to give these guys some love. Guys, go follow each and every one of these gentlemen. So I'm going to throw up some information here. You can connect with Scott Myers, selfstorageinvesting.com. He's also got a great podcast, Self Storage Podcast. So definitely encourage you to go follow Scott. Check him out there. Mr. Mike Wagner has built an amazing community over at, if you go to members.thestoragerebellion.com, very active community. So definitely want to encourage you guys to go connect with Mike there and the rest of the community. That's just filled with go-givers, by the way, people that are just answering questions and helping. Kevin Bupp, Kevin's got a couple of podcasts, which you can see right over his left shoulder: real estate investing for cash flow and mobile home park investing. Kevin, did I get those right?
That's it. That's it.
So, and how long have you had your podcast, Kevin?
I've been doing the real estate investing for cash flow podcast for going on almost 7 years now. And then the mobile home park, I think it's right around 4.5 years. So quite some time.
Well, man, my hat's off to you, because I know the time, energy, and effort it takes into producing a show. And so you've been doing this, man, I've been at this 4.5, 5 years, and you've been at this longer, man. So really appreciate the content you put out. And then Ryan, let me know if there's anything else you want me to add on here. But is this the best place to connect with you?
Definitely the best place. I'm very active on LinkedIn. My podcast is Mobile Home Parks in Real Life. I stress the in real life portion. It's not very sexy. It's for people who want to do mobile home parks, not get hype drunk on them. That's literally MHP IRL. or just go to my website there. It's all there. I also have a mentorship program too. If you want to have someone look over your shoulder and make sure you're making the right calls, that's mobilehomeparkmentors.com. But like my favorite rapper Tupac says, I ain't hard to find. I'm the only Ryan Neris that I know of. You Google me. I'm pretty sure my LinkedIn is the first thing that shows up, and my website's like the second thing. So I ain't hard to find, y'all.
Yeah, man. If I didn't already say we were gonna have one question, I would have ended on a Tupac quote. But let's go ahead. Wow, now I have to go back and find this here. By the way, just to show you some love from the community, Brian David Stannard. Hopefully, I said that right. Man, you guys are inspiring. Love how Mike travels with his family in an RV, as that's a bucket list for me and my family. So a lot of guys are just showering you with love. Here's the last question. I just found it. Scott Spear. What do each use as an average expense percentage to income? 33, 45%. Do you have an average?
Oh, so I think Scott is talking about income to expense ratios, and maybe he's asking about both asset class. I'll just say that the industry average in storage is 30 to 35. We use 33 when we're doing back of the napkin math. And then I'll let the mobile home guys take.
Yeah, I think we have more variables in our space. And so I'd say on the low end, right around 30% back of the napkin. And then on the high end, if it's got private utilities, it's got a lot of park-owned homes, it's got older infrastructure, it might be as high as 50%. But our average across our entire portfolio runs right in the 43% range. Ryan, you got anything to add to that?
I'll second that. It all comes back to strategy and what Scott said earlier. You really need to make sure you are well researched. You know exactly what you want to carve out within the space, because the fluctuations are insane. You can't use a median or average. You really need to understand what you're chasing after. So my more heavy value add stuff, I mean, in theory, I could lose money. Right, I could have over 100% expense ratio, and then on some of my best properties, I'm 25%. That those are direct billed utilities where basically all I have to pay for is the trash, and the taxes. So like, it just depends. I would say on average, we're in the low 30% range, but I'm mostly city utilities. I'm mostly in big MSAs. So rents are going to be a lot higher. If you're off in more rural stuff, Kevin, like the one I told you about that I'm closing on today, the expense ratio is just going to be higher. So when you're getting into this, it's going to be a wide range. I really caution against using a rule of thumb unless you need to make a decision within about 5 minutes. Because you can always back out and due diligence if stuff doesn't make sense. But I definitely would strongly caution against just an average or rule of thumb.
Well, and Ryan, just so they understand, Ryan, I think when you're talking about 100% expense ratio, he's talking about during the value add. So I don't want anyone to think, well, why would you buy a stable asset that's losing money? That's not what Ryan's talking about. He's saying in the first 6 months, the first 12 months before I explode the value and increase the cash flow. That happens in storage too. By design, we buy facilities that are losing money. Once you're stabilized, the average becomes more predictable. But to Ryan's point, there's variability between markets. And so relying on a rule of thumb is a fast way to pain in many cases.
Yeah, probably one of the biggest mistakes I see new mobile home park investors make is literally buying a park based on assumptions, literally using that back of the napkin and not truly understanding the underwriting process and just literally going off a whim, 30, 35%, 40%. And they don't take into account all the different variables that exist. And it's a big no-no. I mean, like, unless you absolutely have to do it just to get an offer on the table because you're in a time constraint, you always make sure you underwrite the entirety of the thing. Don't just use that back of the napkin.
If I can kick you in the butt. At the end of the day, that's what we're talking about here. A 35% expense ratio based upon a 50% occupied mobile home park or self-storage facility, or 90% occupied, totally different thing. So don't go out and begin looking for and asking when you have access to folks like us, hey, what's your average for this? And then just check the box and say, oh gosh, I don't have to do any other research because I've got all my averages now and I got them from here, here, and here. Learning to invest in commercial real estate based on watching people's free YouTube videos and forums in a 2-hour show like this is a recipe for disaster. You need to understand the art and science behind and what goes into underwriting. And then you have consultants and other folks come alongside of you. So, yeah, this is the back of the napkin math is offers only, or see if you're in the ballpark. It's really the triage, weeding out opportunities. And then when you get something, either you're getting ready to write an LOI or an offer on, and then certainly during due diligence, that number is going to change. And then, that's when you begin to do the forensic due diligence, if you will. So,
yeah. And to that end, Scott, while I think we accomplished our goal of just educating, inspiring, and entertaining, we're just scratching the surface here. So I don't know who said it about putting in your 10,000 hours, but if you're committed to something, whether it's self-storage or mobile home parks or any other asset class, any business, you got to put in your 10,000 hours, if not more. And we're just scratching the surface here. So hopefully this kind of piques your interest if you were curious about either asset class. I think it's clear that you can't go wrong with either, unless you get constantly distracted by the shiny object, and then you're kind of scratching the surface here and scratching the surface there. And so with that, gentlemen, we want to wrap up this debate. Thank you so much again to you guys for your time. Thank you to everybody who has either just been here, using your time to watch us. And for those of you like Philip, like Scott, like so many others, Kevin, who have made a donation. Ken, I just really appreciate you guys opening up your wallets and your hearts and helping these families. I know it's going to go a long way. And so just thank you guys so much. Again, as we wrap up here, let me just throw it on the screen here. The Flip Empire Show. If you guys are not subscribed, I feel like I open up my heart and kind of pour my heart and soul into that thing and just share what's working, what's not working, the wins, the struggles, the challenges. And I just kind of let you walk alongside my journey in an effort to inspire you, to educate you if I can. And so if there's anything I can do to help you guys, I'm very accessible. I'm here for you. And so I just thank you for taking the time. We're over 2 hours here, 2 hours and 10 minutes. So thank you so much, Shalin, Kia, Scott, so many of you guys, overwhelmed by the support and by the comments and the participation. So Mike Wagner, Kevin Bupp, Ryan Norris, Scott Myers, you guys inspire me in so many ways. I respect you on so many levels. So thank you once again for taking the time to participate in this second real estate investing heavyweights debate. Really appreciate you guys.
Feelings mutual to all of you.
Thank you.
Yes.
Thanks for putting it together, Alex.
Thanks, guys. Much appreciated.
Have an awesome one, guys. Take care.
You too.